What is going on, everyone? Today is the big day. We have Iren limited reporting earnings in about 30 minutes. I don't know the exact time they're going to report earnings. We also have Opendoor reporting earnings, the trade desk. We have Affirm Holdings reporting earnings. We have a lot of companies reporting earnings. But in this stream, I'm really going to focus in on Iren and Opendoor. Going to cover the basis on both of those, and then after that, we're going to kind of go through the earnings and what's actually presented here, and then we're going to listen to the Iren earnings call, and I'll kind of give a little bit of my thoughts following the end of the earnings call, or when it seems like it's going to end. But anyways, starting a little bit early here today because there's more than a few things to cover. The first of it that I wanted to kind of go over a little bit here is the Iren investor presentation from last quarter and kind of like what I expect, recollecting on the recent news that's happened with the company lately. So let me just go ahead and share my screen. Hold on. All right, so I got that playing in the background over there. All right, so this is basically the earnings from last quarter. Overall, it's a profitable business. The only thing is that most of the profitability is coming from the Bitcoin mining. And as they're continuing to make this transition from Bitcoin mining into pure data center and AI cloud, then that's when you start to possibly see maybe a little bit of a drop off in profitability. But when you think of the long term, you see the Microsoft contracts coming in $9.6 billion, and then they're going to be turning around and paying Dell to help them construct the 200 megawatts capacity. It's might be a little bit of a bumpy road until we do actually reach that point by the end of next year when we start to see that annual recurring revenue from Microsoft actually come in. So one thing we got to make sure we know here coming into this earnings is that the current profitability standpoints is not going to be so important. What's going to be more important is any news we get from the Microsoft deals that just came out, or maybe any future deals that come out, or any updates as far as like when the build out's going to start, when they're going to break ground and so on. They're supposed to be building 200 megawatts of capacity or the data centers in Childish, Texas. So it wouldn't necessarily be an existing data center that they're actually going to build out there. But one thing that we do know is that Microsoft is paying about 20% of the $9.6 billion up front. So let me just bring something up over here real quick. We got the we got the earnings from last quarter. They're basically projecting $1.94 billion in ARR, targeting by in the next couple of years. What I'm going to be looking at though is there any news in terms of like do they bump up those numbers? Are going to give a little bit of clarity as far as the capex that revolves around the cost of building this data center and compute out? Because there's been a little bit of debate on Twitter basically saying like, hey, they're going to be basically losing a few $100 million over the course of this entire contract. It's not necessarily a good deal. My rebuttal is that, well, we're making a lot of assumptions here. We're making a lot of assumptions of how much they're going to be able to get per megawatt in this data center, but we're also making the assumption of how much it's actually going to cost them. And one thing that we do need to know with Iren is that they own basically all of the land, they own the building, they own all the hardware and all of that, right? So then there's a depreciation factor, but also they're able to reduce the cost of how much they can actually, hold on a second. They're able to reduce the cost of how much they're going to have to pay these power companies, the land for the leasing, whatever it is. They're going to be able to get the smallest margins on those as far as the cost because they basically own everything. Now, if you think of something like CoreWeave, well, CoreWeave does a lot of co-location and they do rent a lot of rack space in data centers. So they do have a lot of overhead costs in order to be able to provide that service for a lot of their clients. So I actually wasn't sharing the right screen here, so please excuse me. Let me just go back over here. Okay, cool. So again, last quarter, we did get some really good updates, and that's something I'm also going to be looking for coming into the next quarter. You know what? This presentation is actually the slides that they provided for the Microsoft data center. I was actually wondering when I was looking through there what that was for a minute, but I wanted to bring up the hold on, that's a Q1 reports. Q1 fiscal year 2026. Yeah, they're reporting fiscal year 2026 here. I believe this one is the one. Yeah, so this is from the last quarter. One thing that they did spec out, which was pretty much like what really stood out with this company, was that they're planning to add 750 megawatts of capacity to bring the total capacity up to 2.91 gigawatts. Okay, so they have their timeline in the last earnings presentation over here. Hold on. Yeah, right here. So they expect to be by the end of the first half of 2026, they expect to be at about 2.31 megawatts of capacity. And then after that, they expect to be at the 2.91 gigawatts capacity by the end of the first half of 2027. So I'm pretty sure, and this is an assumption that I kind of baked in here only because I was looking at the operating and under development. What they have here is that they already built out 885 sorry, 810 megawatts capacity. So I believe that this is actually going by calendar year, and the fiscal year is how they're reporting their earnings. So when you think about it in that case, in 1 year, they will have 2,310 megawatts capacity built out, which is about the halfway point of 2026 calendar year. And then by the end of 2027, they're going to have 2.91 gigawatts. So that's basically triple the amount of capacity that they have today specced out in the next couple of years. And we just heard probably the first biggest hyperscaler deal that they've ever announced publicly as far as like who their client is Microsoft with 200 megawatts capacity of additional compute that's going to be built out. So it could be more, it could be less. I think we're going to get a little bit of clarity in terms of that sort of development and planning. But at the same time, one thing, again, we're not trying to look at the current numbers of today and saying like, hey, are they still profitable? Are they growing faster and so on? The thesis of this company is more of like a 1 to 2 year at least to see this whole thing play out. And I would say, let me just actually bring up the stock chart here. Oh, we're getting a little bit of a pullback into the close. So I would say here that the stock price has basically been on a breakneck rally for quite some time. All right. So we basically just went vertical for quite some time. And a lot of people, and I hope that a lot of the audience isn't buying today, hoping that they're going to pump after earnings, because they could not pump after the earnings. They could drop based on whatever short-term prediction algorithms. It looks like growth is not necessarily favorable in the market right now, so it's getting a little bit of a pullback here. In all the data center stocks, including Cypher, Nebius, Iren, they're all about like down like 10, 12%. This is just day-to-day moves, especially when it comes to a lot of these growth stocks. But on top of that, a lot of momentum's dying. So you're going to get things that were leading the theme into the bull or into this part of the bull market is getting sold because of fears that the market might go lower and so on. I think one thing we need to understand here, I'm also kind of talking to myself here, is that we need to understand the position sizing we're putting in this company, right? In the stock per se. So if you're buying like 20% of your portfolio in Iren, hoping that it goes up in a couple of months, you need to understand that, look, it already had a crazy run in the last couple of months on its own. Are you just looking for a quick trade here? And if you are, you might need to be a little bit more realistic in this sense. But if you're thinking more of a long term, like I would say at least a year out for things to like really start playing out here, then that's when you can start to consider like a long-term investment in building like more sizable position. For me personally, I've said it more than a few times. My position is about 3 to 3.5%, and it's only in shares. And my Cypher position is a little bit less than 2% now that it's pulling back. And my Nebius position, I believe it's around, I want to say 12%, but because of the recent pullback, maybe not so much anymore. But those three companies that I have are all in shares. And I'm not playing options coming into this earnings only because, one, the premium is just so excessive. But also, my brother's like looking at a bunch of stuff there. Hold on a second. My brother is a futures trader, so he's always looking at the short term and everything. And he's like giving me like these pointers like where he thinks the market is going to be headed and so on. But anyways, what might be happening here is I want to be bullish as earnings, and I want to be bullish as earnings based on what we're going to hear in terms of news that comes out for this company. But I'm going to be realistic. Like, if this thing is down 10% after earnings, it would probably more the fact that maybe the market is kind of digesting the reality that this isn't going to happen tomorrow, or maybe there's going to be a lot of short-term traders that are in this stock hoping that they're going to be able to double their money and so on, and then they see it, they get stopped out and so on. I'm sure there's a lot of traders in this. The stock is very volatile. Like, it's down 12% today. It was up like 12% the other day, like, and so on. Like, that's just how these sort of names work in the market. But am I going to the earnings thinking that we're going to pump? Maybe. I would say that if it's anything, this earnings might be an option selling event. In my opinion, like, would I sell covered calls in this earnings? I don't have any covered calls in it. But would I buy puts or would I buy premium in it? I probably wouldn't do that either. So I'm really just going to sit in my shares. Actually, if we do get a pullback, probably in the let's see here. We got the 20-day moving average at about 62. We got the 50-day moving average at 49, and we got the 200-day moving average all the way down at 20. If we do maybe test the 62, break below that, because I was adding last time we broke the 20-day moving average, I would probably consider adding in the low 40s, only because I already have the 3% position. Do I want to make it like a 5% position? Probably not. But that's for me, and that's my own risk tolerance. So, hearing a ton of negativity, time to buy. Well, I mean, yeah, you can go ahead and buy it if that's really the case. For me, I'm not going to buy here. I already bought much lower, so there's no reason for me to buy here. But, like I said, if you're thinking about buying for the long term, then, certainly go ahead, because my forecast is that this stock is going to be 3 to 4 times the amount in the next couple of years if things really do pan out. But to be honest, a lot of that really matters on macro, right? So if the market starts to get bearish of the spending that we've been seeing in terms of the data centers and companies, like, well, then these are going to be the first stocks to hit. But if that momentum starts to continue, then they're going to run up, so it's kind of a gamble you want to take. But I would say the best practice here for a long-term position is to maybe add or lower your cost basis by buying at lower prices or dips and so on. And today, maybe it's a dip, maybe it's not. I mean, who knows? Who knows what's going to be after earnings? But I would say that if I'm going to aggressively add to this position, like, I'd have to see a material pullback. So that way my 3% position would become like a 2% position. Then I can beef it up to 3% position. So, yeah, I mean, we're all in this together. And, I know you're saying low 40s. Well, guess what? If it doesn't go to low 40s, then that's fine. I already have a position built. There's no reason for me and my risk tolerance to go above a 3% position. For some other people, we might get people who want to go 10% on it. Well, then that's fine if you want to do that. But I'm just telling you exactly how I would do it and how I would build my portfolio around my own risk tolerance. So with that being said, we also do have Opendoor reporting today. So actually, I wanted to add a few names on this list here. All right, so we have Opendoor today. We have Iren today. We got a few other names reporting today as well. Yeah, man, I'm pretty excited for this one. Do I expect it to fully go down? What do you mean, like 100% after hours? No, I don't expect it to go 100% down after hours. Do I expect it to go down a lot after hours? I don't think it's going to go down. If the market's dropping after hours, and this stock is probably going to go down. But if we get more clarity on the deal with Microsoft as far as what they expect their bottom line to be in the next couple of years, I know they're reporting adjusted EBITDA, but if they guide up on the adjusted EBITDA for the next couple of years, then that might actually bump the stock up. That might get people pretty excited and be like, oh, wait, then that means that my calculations that they're going to be losing money over this contract for the next 5 years is actually the opposite. They're going to be making a lot of money off it, which I do believe that they're going to make a lot of money off of it. Because why would they do it in the first place? Why would they make a 5-year, $9.6 billion with Microsoft and then turn around and then buy $5 billion plus from Dell if they were going to make money off of it? Like, I don't know. Wait, I trust management. I think management has a great background in terms of finances. They both work in energy. It's a dual CEO relationship between two brothers. I've already looked into it, and I've made my decision. Like, look, there is only one thing that's going to make this company fail, right? And a lot of it's going to be macro. If the hyperscalers stop spending, then I would say it would be very hard to argue the bull case in the near term for how this company is going to go. But in the long term, I don't think they're building out 3 gigawatts capacity because they just feel like it or because they think they might make money. These are people who have a strong financial background. They've already spec'd this out. They've done it before they created this deal with Microsoft. And I do think that they're going to be successful in doing it. The only thing is that, like I mentioned, if there's short-term pain in the market, I can't say whether stocks go short-term. But if this does get to the 40s, I'm going to buy the dip. If it doesn't, that's okay. That is totally okay. All right. So earnings that are be coming out today. Let me actually bring this up on my list. It's about 12:46 right now. Cool. All right. Let me bring this up on my list. Wow, we have a lot of earnings today. I did not realize we have more than just these. PBR, Petrobras, Airbnb, Take Two. That'll be interesting to hear more on. That's GTA, right? I think that's Grand Theft Auto. SanDisk is reporting. That's an earnings. That's a data center company. Expedia. I already said AFRM. DraftKings is reporting. I don't know if you guys ever heard, but this morning, Disney announced a partnership with DraftKings, and they're basically replacing Penn Entertainment. They're cutting I believe it was a 10-year contract that they cut. It was like a $2 billion 10-year contract with Penn Entertainment. And Disney ESPN basically cut that, and they paid whatever they had to do to terminate it early. And then they're signing up with the new sports betting operator, DraftKings. And I mean, DraftKings is actually up earlier today, and it looks like it pretty much faded, but so did the entire market. So I wouldn't really, if you're a DraftKings bull, just consider the short term on the macro is really going to make a lot more movement impact on the stock than anything. And let's see here. Akamai. I don't care about Akamai. Oh, Archer's reporting. ACHR, SMR. Stone Cove's reporting too. Oh, ABCL, Accelera. I know a lot of you guys are part of that stock, so that'd be pretty interesting. 5.9's reporting, and I don't really care about too much about the other stuff. All right, so let me just move this one up on my list because that's one I was actually interested in seeing. Affirm. All right, cool. Okay, so like I mentioned, we also have Opendoor reporting. This one's going to be an interesting one. Well, part of it is because there's a lot of people who are long this stock, including myself. But for me, this is like a 1% position, just something I just want to monitor to see how it's doing. But more because this is a turnaround story on rates coming down. So one thing that gets me pretty bullish Opendoor is the fact that the CEO is the previous chief operating officer of Shopify. And I've watched a few interviews with him, and it sounds pretty compelling story. And I think that if the housing market comes back, then a stock like this would actually do good. So is this like a long term hold or not? I haven't decided. It was just like a small nibble position. And Trade Desk is also reporting that one's going to be an interesting one because it's been some time. Basically, Trade Desk has been on a massive downtrend, and it's actually coming into this earnings around its 52-week lows, and it has not been able to catch a break. Like, I don't know what's going on here. I mean, I kind of do know what's going on here. I think a lot of it has to do with the fear that all these advertising companies are basically going to eat Trade Desk lunch, especially with App 11. App 11 might be getting into the demand side platform, which is where Trade Desk lives in. And if that happens, then they're going to start stealing market share for them. I mean, we'll see what happens. Hopefully, Fubo gets some sport betting integration. I mean, we'll see. I think Fubo has already partnered with another company. I forget. Yeah, no, you're right. If hyperscalers pull back, everything's going to pull back. I mean, these are the largest companies in the entire world. That is like 50% of the weighting in the entire stock market. So if those pull back, the whole market's going to be pulling back. So yeah, we do have a pretty bearish close happening over here. I mean, one thing that I did kind of notice is that we're going to be closing below the 20-day moving average in the Qs, which isn't necessarily a bullish sign in the short term. IWM is really getting killed here. I mean, that's a nasty candle that you see. And the rest of the market, we have SPY. Oh, wow, it's already at 670. I mean, I didn't expect it to be green today, but I didn't come in today thinking the SP 500 is going to be down 1%. So like there's definitely some real fear in the market. The thing is that it literally just takes like one tweet out there to basically reverse everything, right? Like if we come out with news later on, like they're probably going to do it overnight because they usually do it overnight, that the government's going to open again tomorrow because it came to a resolution, or they're going to vote on Sunday, whatever. Like the market's just going to rally after that. Like that's just it. We've seen this happen so many times. Like if we look at this chart of SP 500, like we got a scare here, we got a scare. Well, we did have this scare right here, but then we also got scared here. We got scared here. We got scared here. We got scared. We got scared. This was one I kind of worried about after that flush. And I'm not going to lie, I got a little bit bearish during that time, but look what happened here, right? So do I think this is going to do this? I don't know. Your guess is as good as mine, guys. I think the market is anticipating the job slowdown numbers that came out this morning. I forget the name of the company that released that jobs data. Let's actually take a look at it. We got 9 more minutes till the market closes. I think it was our boy Amit that did post that. Let's see here. Oops. Oh, no, he did not post that. Yeah. The jobs data. I forgot the guy's name. What was the name of the company that released the jobs data? Can you guys help me out here? I'm like running a blank here. Let's see what's going on CNBC in the meantime. Yeah, nothing's going on with CNBC in the meantime. Hold on. Want to get the sound in there. It was ADP. I don't think it was ADP. It was another company that released that jobs data. Challenger. That's right. Challenger. Okay. Where's my chart at? Can't find my chart. Is it? Yeah. So layoffs for any October high since 2003. Um, I don't think this has to do with AI. I think this is more of a normalization of basically hiring. So we went on a massive hiring spree here in 2021, and this is just October, right? So October 2021, 2020, we were still in like kind of a little bit of fear when it came through COVID. And then it was like around October 21 when like we were just going on a massive hiring spree. But like there was obviously months, because this is just October. So the months between this, you saw very little layoffs. Now those layoffs started to pick up, especially last year. And then today, we got the Challenger update that we got the most amount of layoffs basically since 2003. So this is supposed to instill fear in the market. Like this is the reason why people are making a big deal out of this. Like I understand this makes sense, right? There's fear that okay, we're heading to recession. I'm not going to say we're not going to get into recession because no one freaking knows. But if you look back over here, the layoffs usually come after there's already a projected recession, right? So 2000s, right? October of 2000, that was after the market topped. I believe the market topped in May of 2000. And like the market had already sold off considerably over here by this point, by October of 2000. And then you had the layoffs come after that, right? So the question is, are we going to have a recession or is there already a recession priced into the market? And if that's the case, will this number go up next month and the following month and the following month after that? Well, I think that's what the market's waiting on. And the thing is that with the shutdown that's been happening is that we haven't been able to get this data from ADP. We haven't been able to get a lot of data from a lot of these bureaus and agencies to get like a heartbeat in terms of like where the economy's at. So we're seeing like this random spouts of data coming from different directions. It's like very limited. And the market's trying to paint a whole story based on the small amounts of data we're actually getting. And I think the ongoing thing is that it's fearful because you get like one or two charts a day, and this is one of them. And every single person on Twitter is posting, spreading FUD, right? Not every single person, but there are some accounts out there that are spreading FUD. I think that if you're going to be investing in individual stocks, you need to really keep an eye on the macro in terms of like when to get in, when to get out if you're a trader sort of thing, or like optimal buying opportunities. But you also want to focus a lot on the themes, that is the secular themes, and also how the companies that you are investing individually and the competitors are doing. We got basically one of the best earnings we've gotten from Amazon, from Google, from a lot of other companies. And the question is, was that a top? Is this the best earnings we're going to see in a long time? And that's certainly not what they guided for. But now the thing is that a lot of people are worried that the spending is going to continue and that free cash flows continue going down. And I mean, here's the reality. Free cash flows for these companies will continue going down because spending is going to go up, and spending is in the investing activities for free cash flow. So if you're looking at all our free cash flow, yes, we're going to start dropping or compressing in terms of margin on free cash flow. But if you look at operating cash flow, that does not include CapEx. If that's doing fine, in my opinion, then I think the business is doing fine. If we looked at Meta, for example, let me actually pull up a chart here of Meta. I actually want to bring this over here real quick, see what's going on with CNBC. Yeah, if we bring up a chart of Meta, I'm going to do this real quick because I want to get some coverage on here. Yeah, this is the operating income for Meta. Like, does this look? This doesn't look like to me it's slowing down, and I think the market's kind of getting ahead of itself, thinking that this is going to drop off a cliff. But Ahmed was talking a little bit earlier this morning. If his friend thinks Meta is like a buy the effing dip moment, I don't think it's a buy the effing dip moment. I definitely think it's a nibble moment, but not necessarily a buy the effing dip moment. All right, so let's get some coverage here.
Which was the highest since July of last year. So there's just a lot of indications that people are, certainly, if not euphoric or optimistic, at least complacent. And that's another market
I said
risk.
this earlier.
I really am always interested in
I said this earlier. I don't know if it's going to bounce back above $70. I think a lot of it really has to do with how the market's feeling in terms of risk today. Clearly, the market isn't in risk mode today. The market is definitely not in a risk sentiment today. The market's quite bearish today, and again, I didn't expect the market to end the day green, but we did get a little bit of a bounce there, and we're coming to a close here with basically like closing at the lows of the day, or at least near the lows of the day. The low on the Qs was 610.30. Yeah, we're closing on the lows of the day. This is not this is not a close you want to see coming into hyper growth stocks reporting earnings. So probably not the best day to report earnings for Iren, but we'll see. We'll see. You never know what's going to happen. Again, guys, I'm not trying to gamble this earnings. I have no calls or anything. I just have shares in these companies. So I'm not planning to go hard, basically with getting into calls. In fact, most of my portfolio is in shares right now. So for me personally, I'd be a little bit careful in terms of leverage and margin right now. All right, so where is gold at? Gold is still below 4,000. If we saw gold rally today, that would probably be something to be a little bit worried about, but I don't see gold rallying at all, so maybe that's not necessarily going to happen. Hold on. I wanted to see something here real quick.
And gold's still up about 51% year to date. Jonathan Krinsky, thank you very much for joining us from BTIG. Really appreciate it. As we get ready here to hear that closing bell sound, we're seeing markets under pressure across the board. The NASDAQ is definitely the weakest of the crew, but the Russell 2000 also taking a leg lower here in the final couple minutes of trade. That does it for closing bell. Let's send it over to overtime with Morgan Brennan and John Ford.
Well, that bell marks the end of regulation.
So we have a lot of companies reporting earnings after hours. Let's take a look at the big chart here to see where things are at after hours. Okay, so TTD reported earnings. They are up 8%. Let's see if I can find. Let's see if I can find the details in this one in the side. Iren is down 4% after hours. So they probably released earnings. So let me go ahead and take a look to see if I can find those earnings. Whoops. I usually like to go in a few places. One of them is Stock Titan. All right, they did report. Is it available on their website? Oh, their website's getting hammered right now. All right, so Iren came in at, they're targeting $3.4 billion in AI cloud ARR by end of 2026. So that's actually really interesting. That figure was not up there when I looked at the presentation. So the Iren presentation from last quarter showed, hold on. Let's see here. All right, we'll take a look at that one later on. They're expanding to 140,000 GPUs. So currently they have like 24,000 GPUs or something like that. They're targeting $3.4 billion in AI cloud annualized run rate by the end of 2026. So they're expanding 140K GPUs. We already know that they secured a $9.7 billion contract with Microsoft. Phase deployments are childish through 2026, a 5-year term, and they're going to do a prepayment of 20%, and that contribution is $1.9 billion on an annual run rate to the total of $3.4 billion. All right, so new multi-year contracts together with AI Fluid Stack Fireworks supporting growth to AI. Is that new? I got to double check that one. Total revenue increased $240.3 million at 355% growth. Net income $384 million. That's actually pretty considerable considering. We'll take a look at all that stuff. Adjusted EBITDA $991 million. So I mean, this is the reason why it's a breakneck rally when you see a lot of these like triple digit numbers. Oh, my bad. I was not sharing the correct screen. My bad. No, I have to share the correct screen. I was looking at Stock Titan. All right, project update. I'd really love to get the Iren stuff. Hold on. How is the stock doing? Stock is up 4%. That was random. TTD completely reversed their 8% up. Shysta. Opendoor is down 3%. Whoa, Expedia is up 17%. StoneCo is down 3%. This is the thing with these stocks is like it could just drop and then go back up, and like the algos need to digest their earnings. Okay. We'll see what happens. Like that's why when it was first down 4%, like I wanted to kind of know what's happening. Now it's up 4%. It's like I don't know if this is going to hold or not. But congratulations if you're in Iren. I mean, up 5%, but still down 12% a day. Opendoor has reversed. It's 3% down. ABCL. Oh my goodness, guys. Okay, you guys got to help me out here because I'm trying to bring up a lot of the earnings. Thank you. 135 people are here right now. Everyone's texting about Iren right now, all excited. It's like, I didn't get these texts when it was down 4%. Now I'm getting when it's up 6%. I'll take it. I'm excited. I'm excited about that one. All right, so let's look at our favorite accounts over here. Let's look at our favorite accounts because I know some of these people like Franz, Mike Alfred, they're posting all this stuff out there. Look at it. It's not even called Iris Energy. It's called Iren Limited. So, people, some people did degen into this stock. Okay, I like this account. This is a cool account to follow. All right, so like I said, 240 million, 355% year over year. Net income is 300. I gotta look at like how this is the case. How is their net income higher than the revenue? It was probably some sort of tax thing or whatever. EBITDA, this has to be something wrong with that. I gotta look at that closely. Maybe this is the annual one, and then this is the quarter. Cash $1.8 billion announced. Yeah, okay, that's actually what I saw on there. How we're looking after hours. Okay, we're kind of holding on to those gains. Not bad. All right, so let me look up. I'm sure this guy posted the other stuff though. Iren 800. Yeah, why do you guys do that? He's super excited. Iren is a goat. You know who's the goat? The goat is Nancy Pelosi because she went full-time trading today. She announced that she's retiring as a politician and she is becoming a full-time trader. So she is the goat. She is the goat. All right. So let's see. Oh wow, I forgot Peloton is reporting after hours as well. Ooh, that's a nasty can in ABCO. Peloton is up 5%. So they basically reversed all of their losses from today, just from the recall of the bikes. TTD, all right. TTD, $739 million. So they beat estimates. They grew 18% year over year. GAAP APS actually beat as well. Non-GAAP, whatever. Adjusted EBITDA margin, 43%. Cash flow from operations is $225 million. It looks like they increased their guide. So why is the stock down? It's flat. It's not necessarily down. Yeah. Oh, wow. Opendoor is down 10%. It's in the $5 again. Wow. Man, that position is going to get slaughtered. How did Opendoor do? These guys. I don't think anyone has Opendoor yet. Maybe it's on their website. If I can actually get to their website. No way. Did they actually post it? No, they didn't post it yet. No, they didn't post it yet. Let's take a look at our trusty, rusty stock Titan. I want to see if I can actually look at the Iren presentation when that comes out. Charts path to profitability through software and AI. Of course. You better, man. You better. Everyone's looking forward to that one. All right. So Opendoor. I don't think we're going to be able to get. All right. Scale and acquisitions. More volume means more revenue, transactions, acquisition, contract. Okay. So they want to start acquiring some inorganic growth. So that'll be pretty interesting. Speed and profitability. Okay. So looking at profitability. It doesn't say exactly when. Operating leverage sector, 15 million one-time whole cash award to CEO. Okay, so that's interesting. They got a 15 million one-time cash award. So hopefully he won't get paid after that until he meets some milestones. Gross profit decreased this quarter, expected. Gross margins did contract. Probably not what you want to see. Net income did contract. Okay, homes sold. They sold less homes this year than they did last year for the quarter. Homes purchased, they purchased less homes. Okay. So homes in inventory then the period, they have half the amount of homes they sold. So I'm wondering, did they sell some homes at a profit this time around? We'll see. Adjusted EBITDA contracted, so it actually got worse. And that's adjusted too. So that does not include a lot of things. We are diving into acquisitions, expected to increase at least 35% from Q3 as product launches. They're looking to acquire a lot more companies. Expected increase from the outlook we provided from Q2. So they did increase guidance, but it decreased approximately 35. Okay, so this is probably it. So they're expecting to decrease their revenue 35% quarter over quarter due to low inventory next quarter. And that would make sense why they're down about 4. Well, they're not down 10%, they're down 4%. So it'll be interesting to see. Looks like Iren is about to go flat again there. That's why it's like I don't necessarily believe the short-term price action when it comes to a lot of these companies. All right. Earnings call and details. I think that was, here we go. There's more stuff. Revenue. Oh, okay. This is just the 3 months ended. Yeah. It's like going down a gutter. But, if this is like a speculative play, which for me, it's a speculative play. I'd keep it small. Do I think we're going to hit $82 the next couple of years? I don't know, dude. We need the market to stay bullish, and we need to get some rate cuts in order for that to happen. I think the market's just going to run with it if that does. But we're going to get those rate cuts anyway. So I think this is probably a decent bet in the speculative portfolio, just in case I want to see that happen. Yeah, we can go more into that stuff once I get the earnings presentation. Let me see if the Iren website is loading right now. Any coverage in Iren right now? Expedia. No, they just went over
AI investment, meaning the companies are taking so much cash and they're investing that in AI that they're cutting people
over
in order.
Expedia right now. Let's see. We got it.
Ceased all sales of products
material
in China, in part because of its deal with the Pentagon. That resulted in no revenue recognized from rare earth concentrate during the quarter, driving the 15% decline in consolidated revenue year over year. So keep that in mind with that top line number. That said, production ramping. It's at record levels, and that Pentagon price protection agreement going into effect on October 1st. Now, MP Materials CEO and founder Jim Litinsky telling me, quote, in the current quarter, we're going to return to very healthy profitability, and we expect that beyond. So obviously, there's now an official significant inflection upwards in our cash flow starting now. Litinsky saying it's on track to produce magnets at commercial scale by year end, disclosing plans to begin commissioning a new.
Is anybody in some of the rare earth stuff? Let me know in the chat if you're still in the rare earth stuff. Also, if you're watching on Twitter, I do have my YouTube channel. I'm going to actually be providing some commentary later through a recording. It's probably a late night one. For that one, as far as like, I got to go through the earnings report. We're going to listen to earnings call on the stream as well. I mean, I'll give some commentary in real time, but I need to look at the figures in long term, kind of try to see like, okay, so did we get additional news? Did we not get additional news? Because this is obviously a lot of information we're getting right now. So I wouldn't really make too much an emphasis on stock price. I do think that if we do, the real move is going to happen tomorrow when it comes to Iren, because right now we're up about 3%, but like this thing is just volatile as hell. Airbnb actually did report, and they're up about 4%, so that's not bad. My only thing is that Airbnb has basically been flat for like the last few years. I don't know if Airbnb was a fad or not. If there's a company that I would bet on, it would be Booking.com. Booking.com is basically their number one competitor, but like by a landslide. Like Booking.com basically owns like a lot of the travel and leisure booking. But the market's kind of telling you with travel and leisure that things are not looking so good. So that's why that's been drawing down per se. Accelera, let's go ahead and see if we can find some stuff on Accelera. What is oh, they actually got Take Two. I don't know if anybody's got Take Two, so I'm going to play this one real quick while I look up the Accelera results.
Two Interactive earnings are out, and that stock is tanking too. So Steve Kovac has those numbers. Steve.
Yeah, let me tell you why here, Morgan. It's not because of the quarter that they just reported. Those numbers look good. It's the further delay of Grand Theft Auto 6. It was supposed to come out of May 26 next year. They're now delaying that to November of 2026. This is the second delay for this game. And so you see...
Dude, that's not the second delay. That's like the millionth delay. Like, if anyone is waiting for Grand Theft Auto 6 to come out, like... you're not going to get it to 2027. You're not going to get it to 2027, guys.
Shares reacting there. This does not affect their current fiscal year, but you can imagine that once we get guidance for their next fiscal year, that's going to adjust some things as well. This is still going to be a really big seller, regardless of when this comes out. The anticipation is through the roof for this game, and these games are incredibly complex to get off the ground and make perfect before they launch. It's a huge, enormous effort. So it's not unusual for them to get delayed, but here you see shares reacting down nearly 11%, guys.
Yeah, that's rough. Well, we got more earnings from some fintechs, Block and Affirm. Mackenzie Segalos has those numbers. Matt.
Hey, John. So it's a miss on the top and bottom line for Block. Those shares down more than 8% right now. Adjusted EPS coming in at 54 cents versus the 67-cent estimate. That is on revenue of $6.11 billion for the quarter versus $6.31 billion expected. This is the fourth straight quarter the company has reported a double miss, and it's sixth straight quarter that it's missed on revenue. Adjusted EBITDA also coming in light at $833 million versus a street estimate of $840 million. I did just catch up with CFO Amrita Ahuja. She pointed to gross profit as a bright spot, saying they've now seen back-to-back quarters of double-digit growth there, and they're now guiding to $10.2 billion in gross profit for the year. Okay, turning now to Affirm. Those shares about 4.5% higher now. It is a beat on the top and bottom line. EPS coming in at 23 cents, which is ahead of the street estimate of 11 cents. Revenue is $933 million for the quarter versus $883 million expected. Gross merchandise volume, a key metric looking at the total value of transactions that hit $10.8 billion, topping forecasts. And guidance for next quarter, that actually came in a touch light at $1.03 billion to $1.06 billion. But for the full year, gross merchandise volume is
My bad, my bad. Definitely not as good as I'm in this one. But I'm definitely bullish. Affirm and also Klarna. The reason why I'm choosing Klarna over Affirm is, well, one, I think that it's got a lot more room to the downside because of its recent IPO. I mean, this thing's been a massive downtrend since IPO. I did buy it on the IPO, but also Klarna has a major presence in the EU, and they're much further ahead of us when it comes to their rate cutting and quantitative easing cycle. They don't necessarily do quantitative easing, but the inflation rate in Europe is a lot more dramatic, so they're going to put more pressure on bringing rates down a lot faster in the U.S. But obviously, you know, when you think of Affirm, I think both these companies will pretty much trade in tandem when you think of performance. But I looked at Klarna; it looked pretty interesting, and I could go more into Klarna another time. Can you tell us why Nebius over Iren for you? So I own both. I don't think it needs to be some sort of like one is better than the other one. I got into Nebius around like $24, and oh, look at that, Nebius is actually up a little bit after hours. There's two things. There's two big differences between both of these companies. So Nebius is a group of 5 different companies in its portfolio. Everyone knows Nebius, which is its core business, mostly configured around data center co-location and also owning the whole stack top to bottom. But they're also an AI cloud, which means that they pretty much act like a hyperscaler. So they build a software on top of all of the hardware that they either own or rent. And the reason why that's important, especially for Iren as well, is because they can have the lowest marginal costs in terms of providing the services directly to the client versus like through Microsoft and so on. But also on top of that, there's a lot of optionality there. They have a much wider reach when it comes to services that they offer versus like something like CoreWeave, where it's like we could just rent you out the workloads right through the GPUs, or maybe Cypher, where it's like we could just rent you out the hardware, you build your software on top of it. Iren and Nebius can do both, right? So that's the reason why I like both of these the most out of all of them. And Cypher does have that option. In fact, if you guys want to check out the Cypher earnings call that I had from last Monday, the CEO was asked, Tyler Page was asked for Cypher, would you be willing to get into providing AI cloud or the software on top of the hardware? And he basically said, not right now, right? So why do I choose Nebius over Iren? Well, okay, so Iren is a much smaller position than Nebius, but Nebius started at the same size as Iren, right? So I didn't make Nebius 12% out of the gate. Right now, Iren's about 3%, right? So if Iren goes like a 3-bagger, then yeah, it will be like 9-12%. But with these kind of companies, like look how volatile it is, right? I mean, Nebius could probably double from here, maybe next few years. But with my risk profile, I don't want to make that big. So now with Nebius, they're much more diversified in terms of their business, not just focusing on AI cloud or renting out compute and so on. They're also focused on building their AvRide business, which is basically their autonomy sector for driving and also delivery for robots. They also have Toloka, which is basically AI workloads as a service for companies. And a lot of companies use them like Shopify, Cloudflare. I believe even Anthropic uses them as well. It's either Anthropic or Perplexity. I forget which one. But definitely much strong usage when it comes to that business. And even at AvRide, they even partner with Uber and DoorDash and so on. They have another company, Triple 10, which a lot of people don't really know about, which is more of like an education suite or education courses for people to take that want to specifically gear toward engineering and AI. And then they have a 28% stake in ClickHouse, which is like last time we saw was a $6 billion valuation, which would put it around like $1 to $2 billion. I think the valuation is probably closer to $8 to $10 billion today, considering the multiple expansion we've seen from Snowflake as well as Databricks, which is like one of their biggest competitors. So I think that could provide some cushion in terms of that. But the thing is that it's a very capital intensive, CapEx intensive business, obviously, when it comes to data center build out. So the CEO has said that, look, these other businesses are funding the core business, Nebius. So that is why I'm in Nebius. It does reduce the risk profile with these other businesses, but it is mostly because they have a major presence in Europe. Iren has a major presence in the US. So they do overlap with one another, but because of the fact that Nebius is located around the world, they already have these relationships with countries around the entire world. Maybe Iren might look out for something in Australia, but they really focus on the US because that's where all their data, that's where the majority of the data centers are with the 2.9 gigawatts capacity. Yeah, they have data centers in British Columbia, but that's mostly focused on Bitcoin mining. But they're basically building most of the stuff in the US. So one thing to remember is that most of the compute demand is in the US, right? So now with Iren, like I mentioned earlier, it is an AI cloud. They own the land, they own the hardware, they own the building, they build the software on top of it. And they're continuously providing the services for everyone, right? And Azure or Microsoft is basically renting out the compute for them, not necessarily paying for their software, right? So that's why they're building it separately out for Microsoft. And I don't choose one over the other. In fact, I think that if AI is real, which I strongly believe it is, these will both benefit. I don't think like one's going to 20 times and the other is only going to go up like 2 times, whatever. I think they're both going to work, and I think they're both going to outperform the market, which is the reason why I invested them in the first place. But today, I would say today, this is mostly looking at the price action with it is that like clearly the market is favoring Iren, but both of them will go down if we continue to have macro pressure to the downside. So does it really matter which one you pick if you're bullish both of them? Now, if you choose one over the other, then clearly that's what you should focus on. Like I don't think you should. If you're really bullish on Iren, then like don't buy Nebius, right? Like I'm not buying Bitfarm or Applied Digital or any of these, most of these companies, because I've chosen that these three that I want to invest in. Cypher is a much smaller position, but like these are the three that I'm investing because I feel like these three have the most probability of success. The other ones probably might, but like when it comes to confidence as far as like whether it's going to succeed or not, those are the three that I'm really honed in on. All right. I don't think it's fair to say that the price action is favoring Iren since Nebius already shot up with huge yield with Microsoft. I mean, that's what I'm saying with recent price action. Like this is just going solely with price action, right? The market is all about Nebius and Cypher right now, right? I'm sorry, Iren and Cypher right now. Now, fundamentally, I think all the companies are just sound. They're just fine. But like, yeah, Iren is like near its all-time highs. Nebius is like 30% from its all-time highs. So, but like that could just change tomorrow. So that's why, like I try not to focus too much on like which one's better than the other, and I choose not to be involved in those conversations because like there's some guys who like really dig down into stuff based on today's projections. But if I were to invest in a stock based on the facts today, it would be very hard to see what these companies can become in the future just based on what we know today. Because if they are based on what we know today, then the market has priced them fairly. But if we consider just the secular theme of how much these data centers are actually spending and how they all say across the board that there's not enough supply for the demand and that they're already turning to these smaller players, then do we think that that topped? Do we think that that's it? I don't think that's it. I think it's continue going. All right, so let's see if we have some coverage here with
you've been talking about. We had this conversation with her directly, and I think she's presenting
about that one. Hold on, let's see if we've got some coverage on. Oh, they're talking about the shareholder meeting. No coverage on Iren. That's a shame. All right, so let's see if I could pull up the deck. Did I just see that? Oh, wow. Opendoor reversed a 10% drawdown. Dude, these stocks are crazy. Oh, congratulations. Who was the guy that said that they got AFRM? Wow, congratulations, man. 10% up after us. That's no joke. That's no joke. Congratulations. All right. Oh, yeah, Block reported earnings. Holy crap. Block is down 13%, dude. Yeah. What are my price targets? Dude, if everything turns out fine by the end of 2026, I think Iren could be at $140. At least $140 if everything turns out fine. You know, the problem with providing price targets is that price targets are focused so much on micro that if the market decides like, look, we don't believe in Mark Zuckerberg, which they don't believe. We don't believe in data center. We're going to sell this mofo, right? Then how are you going to achieve your price target? Like the market is a voting mechanism and they will ultimately vote in the short term of where things are going to go. So I don't know where it's going to be at the end of 2026, but if things pan out the way that I expect them to, I think 2026 is going to be a great year as these hyperscalers continue to project more deals for these other companies. I think that will continue. So I think around $140 or more by the end of 2026. But you know, don't buy it hoping that that's going to happen. Buy it for probably something a bit more long term with that one, because you can have. I mean, Iren could be at like $50 tomorrow, and then still be at $140 in 2026, or Iren could be at $140 in less than a year, and then end in 2026 at like $50. Like, who knows, man? Like, it's just. Do I think it's going to reach 140 by 2026? I think it's going to be over at least $100 by 2026. That's what I think, and you can quote me on that one. Yeah, I mean, I got a little bit of Cypher too. Like, I'm not trying to. I like to be diversified a bit in certain baskets because that's my risk tolerance, and I think that Cypher, especially with their AWS deal, also they had a deal with FluidStack and Google. I think they have a lot of potential. I mean, I do think that these mega caps wouldn't take stake in these companies if they didn't think it was going to happen. And I don't think that Microsoft would create a deal with Iren if they didn't think that they'd be able to come through. Like, I have every confidence to come through. The thing is that in the short term, like, how does the market really feel about this, right? That's one thing to kind of play around with this. And like, sometimes the market gives you opportunities, right? Like Iren went below $50 just a couple of weeks ago, right? So it's like, you can't look at Iren below $50 a couple of weeks ago and been like, it can't be there again, because that's what people said when it was at $70 a few weeks ago, that it can't. It's like, anything can happen. Anything can happen, guys. I don't really have a take on Bitfarm, to be honest. I haven't looked too much into it. a lot of the information that I get is based on data that's made available to me. A lot of data is provided by communities on Twitter. On the websites, the company only provides so much. So I tend to lean more towards stocks that have a lot of coverage more than anything, because I'm not like necessarily a value picker. When it comes to stocks, I'm mostly in tech, and that would involve sometimes buying things after they've gone up, like buying Cypher when it's $20 versus when it was 7. Like I missed the boat on that one, but I'm arranging my risk by not going like 5-6% on Cypher. So we'll see, man. We'll see. All right. Wow, Peloton is up 10%. What did these guys do last? Crazy.
Of the year. Market moving news and interviews across 3 global live streams.
All right. So I got a little bit distracted. I apologize. Let's see if I can get. Yeah, the website's still being hammered. Yeah, dude. Honestly, the fact they own the land and facilities gives them a big advantage. Also, they're all renewable energy. I believe it's wind in the U.S. or Cypher is wind, and it's hydro in British Columbia. It's likely wind in Texas. That's why they're all centralizing around Texas, like Cypher's in Texas. Cypher actually announced that recent data center, which was kind of surprising. Solifis, I forget the exact name of the data center, but they're all going to be in Texas, mostly because the land is the cheapest, but the power grid deals that they're able to sign up with, the renewable energy that they're able to get out there. I think that the fact that Iren owns everything, they have the lowest cost per kilowatt in terms of operating expenses. Well, the site. Because everyone's trying to hit the site, all the APIs, the algos, they're all trying to hit the site. So it's just hammering the site. Unfortunately, we can't get that information we want. Yeah. So we're seeing Iren here up about 4%. Oh, wow. TTD was up 8%. Now it's down. Man, that's rough. That is rough. All right. How do I disable notifications? Because I'm sick of seeing these suckers out of nowhere. One sec, guys. There we go. Let's disable it here. All right, there we go. Sorry, I wanted to not interrupt. Yeah, Iren's calls in about 30 minutes. So we're going to listen to that one live, guys. ABCL, did they reverse? Okay, they did a little bit of reversal there. This is something that I've kind of been interested in for a little bit, Epsilera. A lot to do with pharma and biotech, but I know a lot of the guys are pretty bullish this one, specifically Arnie. So it just kind of encouraged me to like, hey, maybe let me look a little bit into this one. I don't know about the valuation, but I knew there was like a good narrative going on there, so it might make a good momentum trade. Dude, congratulations, man. Are you Mike Alfred? Can't really tell. Are you Mike Alfred? Is Peloton finally cash flow positive? Dude, if Peloton was finally cash flow positive, like they would be up like 100%. It would be up like 100% if that was the case. Is Iren running? Oh, word. I can't get excited for this. Like we were literally just here like 10 minutes ago. Like I can't get excited for this. All right. Oh, wow. They guided $18 million above the high end of the range. Okay, well, that'll do it. Net cash revenue, operating cash flow positive. Okay. What about the free cash flow? Yeah, I don't see the free cash flow. It's crazy, dude. Crazy people. Let me look at. Like running a blank here. I was just thinking about something funny. Hold on. Excuse me, guys. By the way, thank you, 149 people for being on here. Hey, guys, I'm getting better at this. I'm getting better at it. So I apologize for the latency in terms of my brain. I'm going to get better at it. We always got to improve, right? We always got to improve. So Pelotoni. Anybody have Peloton membership? Let me know. Let me know if you got Peloton. I have a Peloton. I've had a Peloton since 2020, and that bike is still running strong. Amazingly, right? No, 2021. I'm surprised the thing hasn't broke down, but I would say that I've never had any issues with it. But I do pay $50 a month for that garbage. But well, it's not garbage because it works. My wife loves it. All right, so Peloton earnings. Where is their free cash flow? Yeah, that'll do it. That'll do it. Yeah, they increased guidance. That's a pretty big guidance increase, actually, for adjusted EBITDA. And they're expanding gross margin. Yeah, that'll definitely bring a stock up. Here we go. Here we go. All right, cash flows. Net cash right back to. Ooh. Wait. Operating cash flow positive. Investing negative. Oh, wow. Okay. Okay. Was that like a one-time thing, though? I think this might have been it right here. Yeah, this is it. It's a trick. It's a trick with Peloton. It's a trick. Yeah, that's not cool. That's not cool. That's the reason why. This is it. Yeah, I don't know, guys. I don't know when it comes to Peloton. Of course, when I don't long Peloton for a trade, that's when it runs up. That's when it runs up. We'll see. All right. Is this site still being hammered? I really want to take a look at that slide before the earnings call. All right. Not bad. Not bad. Opendoor. At least they're not down 10%. That would suck if they're down 10%. Wow. Nebius is up 1%. I mean, that's some, now that I think about it, that's like some after hours action. Nebius was up like to $123 after hours yesterday. And then here we go. They closed at $109. This thing is still, I really want to take a look at this before the earnings start. All right, let's look at the flight cuts. Oh my goodness, more commercials. See here.
Now it has had 3 in the past 6 sessions, so we are seeing some volatility.
How is it?
7.5%. Airbnb saying gross bookings and nights and experiences booked both beat estimates. Those shares are also up about 4.5%. Wynn Resorts also higher. It missed on earnings, but it beat on revenue. Said things are looking good in both Macau and Las Vegas. Those shares are responding positively. And a split decision for fintechs. It's a mixed picture, as we have been seeing in general there, though. Affirm moving nicely higher after beating on earnings and revenue. Block, though, falling more than 10, well, just under 10%. Its top and bottom lines both coming in short of estimates. Also, don't miss a First on CNBC interview tomorrow morning with Affirm CEO Max Levchin. That's tomorrow at 9:15 a.m. Eastern on Squawk on the Street.
Well, now U.S. markets hitting a record highs this year, but it's still underperforming the emerging market index by a lot. And according to Oppenheimer, around the world, we've got the...
See, this is why I like to have... They posted working links. Man, did somebody post a link? Someone put a link in the chat. Sam Alman today, so we don't have enough megawatts. Yeah, I mean, like a lot of these guys are going to try to pump their own stock, but I think the underlying demand is probably a bit more important than anything. Iren's X account. Oh. Nice. Beautiful. Thank you. Thank you. All right. So we already know about this. Okay. So this was probably the big number that was kind of interesting because I don't think they said that before. So $3.4 billion in AI cloud annualized run rate by the end of 2026. That's pretty good to see. I wonder like how people on Twitter are going to respond to this. Like there's always going to be like bears out there, trying to say some stuff. We do run through the adjusted EBITDA. Okay, so net income increased versus Q1. Okay. All right, I'm going to look at those numbers as we get further down. Transition of data centers from ASICs to GPUs, ongoing, targeting completion. Okay, so they're going from, interesting. So they're going from data centers that are running in ASICs to GPUs by the end of 2026. This is actually very interesting. Maybe they said this is the first time I'm seeing this, so I apologize if I missed it before. But these ASIC chips that they have, especially in British Columbia, these are made specifically for mining Bitcoin. So going to GPUs, or basically general computer, basically NVIDIA processors, means that you no longer have GPUs that are specifically catered toward Bitcoin mining. You now have general compute GPUs, which means that if they don't want to mine Bitcoin, which is very easy to switch, they can utilize 160 megawatts toward AI workloads. Now, they're probably not going to do the whole thing, but it gives them that optionality of an additional 160 megawatts of capacity toward AI cloud if they want to. I think that'd be really cool if someone asked that question on the conference call, and that's by the end of 2026. So that's definitely going to take time to do that. Accelerating construction of Horizon 1 to 4. Okay, so 200 megawatts liquid cooled. Okay, so that's cool. Yeah, we already knew that. Well, actually, I already knew that was liquid cooled. I was reading about that one earlier. Significant enhancements to original Horizon, including tier 3 equivalent concurrent maintained 100 megawatt superclusters. Okay, cool. Design work fan. Okay, so they're switching toward liquid cool. Liquid cooling is a lot better than air. It means you could have more real estate in terms of how many racks you're putting up. When you have air, then that means you need to create the space in between all of the servers for the air to flow through and cool the GPUs. But when you have liquid cooling, that means that you just need like a pipe of the water to be hitting the GPUs and cooling it down, and that can all get reused. So I think it's a bit more expensive, but this is probably the reason why Vert has been running a lot, because they specialize in liquid cooling. Yeah. Vert is an interesting. That's something that I missed. I wish I was thinking about that back then. All right. Sweetwater Hub, 2 gigawatts, targeting April to. Okay, so that's the first half of 2026 that we were looking at. So then that would be about, they already have about 1,000 megawatts, and then 600 by late 20. Okay, so that still is the target for late 2027. So I don't think they adjusted the total megawatt capacity. We'll see it in the rest of the earnings if they do. $1 billion, zero coupon convertible notes. Okay, so 0% financing, $200 million incremental GPU financing, bringing the total of $400 million. Okay, so they have $400 million. Continues to execute, discipline, delivering, cloud expansion. Okay, thank you so much for that information. Okay, so this is, I don't think I saw that before. So only 16% of our 3 gigawatt grid connected power portfolio. They're going to expand more. They're definitely going to expand more. Let's see if we got some more stuff here. Okay. Yeah, that's for the Microsoft stuff. Yeah. No, they said in the beginning. They said in the beginning. All right. Oh, yeah. No. That's good. You caught that one. Yeah. Nice. All right. So Bitcoin mining revenues, AI cloud revenues. Okay. So they're starting. Well, I mean, last quarter, they're already making money off the AI cloud services revenue. So it looks like they increased their AI cloud services revenue by about, this is in billions, right? No, sorry. This is in millions. This can't be in billions. That'd be crazy. So they increased it by, what is that, like 5%? Okay, so but that's going to ramp up later on. This is why I'm not so concerned about these specific figures right now. Total cost, I mean, that's not bad. So the total cost of AI cloud services is $700,000, and they made 7.3. Then that means that most of the cost is coming from Bitcoin mining, but that's because you have $232 million in the top line for this quarter. Total operating expenses is $236 million. Operating income is $76 million. Total other expenses, so income before tax losses. So they're still in the positive range, and they actually doubled net income in the last quarter. So that's always good to see. There's probably some other stuff in here that I'm missing, but I just want to go through this real quick. Cash flow. All right. So unrealized gain loss 665. Do they provide commentary on that? Oh, they add it back. Yeah. Okay. That's why they do it. They added it back. Maybe that's a reason why it's so high. Okay. So looking good, looking good. So that was the amount they said that they have at the end of the year. Net income loss. So they have 160%. Oh, that's why. Yeah, that's why it came up so much. I was wondering why that figure was more. And if I look at, yeah. So they basically had this amount right here. So that's the reason why it was up so much. All right. EBITDA, adjusted EBITDA margin. Okay, so they're actually excluding this to get the real figure. So that's why they always do adjusted metrics, is because this number kind of threw off the entire income statement. So they're taking out all the costs, SBC and everything, and they're coming up with the adjusted figure, and that's a 38% margin, which is less than last quarter. So, here we go. Other one-off expenses, one-time liquidation payment in August 2024, transition, spot pricing, child. Okay, so there you go. That would explain that one. All right. No fancy earnings presentation, unfortunately. Now they're giving me the HTML code reply. Oh man, I don't like to see that. Oh well. All right, so I don't think we have it yet. All right, we got the earnings presentation at 1:47. Ugh. I hope this website's up by the time the earnings call starts, because that would suck. Oh, Archer reported. Archer is up 5%. I don't believe this. I'm sorry. I don't believe that. We'll see what happens. If the market goes down, Archer's going to get hit. I don't care what it is. They're going to get hit if the market goes down. I'm not long it. I'm not long this stuff. I mean, you never know, but like the drone play that I'm looking at though is Kratos, the stock talk choice. But I probably need to look at that more, but that'll be net new capital put in. SMR reported new scale. They're down 14% on the day, and they're down an additional 8%. Let's see where Oklo's at. Yeah, Oklo had a nasty day. Nasty day. Is the market up after hours? Okay. I mean, this could all change in like an hour or so. So we'll see. Block is still down 10%. I thought, oh man, yo, this guy, yo, my dude, appreciate you. Give it time. The big boys need time. Digest get approved by heavy and Iren GPN has its. I mean, please give me $24. That'll be amazing. Applied or MP. Didn't really go anywhere. This rare earth stuff is a pretty crazy trend happening for a little bit. We'll see where that goes. Toast is down 1%. Story of my life. Always happens. All right. I'm going to play this for a minute. Did we get any coverage on Iren? Nothing. Oh, Rockwell Automation had earnings.
Process control all in a single cohesive system. I think, humanoids may have a role in some applications, but I see it as a little bit of overkill for a lot of the applications in factories today.
Looking across your end users, where are you seeing the most growth or the most strength as we look to 2026?
So certainly in the area of e-commerce and warehouse automation, we're seeing probably the strongest year-over-year growth. We did see in the fourth quarter automobile manufacturing, and that's both from some new projects, but also for the very large installed base that we service, pharmaceuticals, and certainly there have been some high-profile announcements of U.S. manufacturing.
Whoa. Dude, wasn't Oscar up a lot this morning? Good Lord. Yeah, no, they were up all the way up here in the morning. Wow. That's crazy. Yeah, I was just taking a look at that one. I like to look at these after. I was going to see if there's like some news that's out there. But yeah, no, we're just waiting for the Iren call. So let me start preparing that and then
manufacturing plants, but we're also supplying equipment and software to those companies around the world. And then food and beverage, which is our single largest served industry.
Well, Blake Moret of Rockwell Automation, it's great to have you on. Thank you.
Thank you.
Well, the shares finishing up about 2.5%, almost 3% today.
Yeah. Well, coming up, with the lack of a government jobs report tomorrow, we're going to look at some alternative data to give us a picture of the market. We're going to break down what LinkedIn is seeing in the jobs market when overtime returns.
I got her a little something. A little something, Dad?
Hold up. Walt rolled his 401k accounts into an
Okay, my apologies. I'm still waiting for the call on that one. I'm trying to set up the call real quick. All the current GPUs so far in Iren are in British Columbia. Yeah. Marks of the first site host. Okay. That's cool. Yeah, I mean, there's only like $7 million of revenue. So I don't even know what that's actually accounting for. But yeah, I mean, he's right. Gary's right. Like, you're not buying this company for their current revenue and current Bitcoin mining operations. I mean, that's keeping it sustainably profitable. You're buying it for the ramp up. And I think the market, I don't know, who knows, they might get a bit impatient. We've seen how the market gets very short-term looking. They get a little bit impatient. All right. Let's see here. I'm trying to pull up. Here we go. Yeah, I'm just trying to pull up the details for the earnings call. Thoughts on Mike Alfred? I mean, he was early, right? I think a lot of people thought he was blowing smoke out of his butt for a minute, and then you look at these companies, they're like 10 times. One thing you got to remember is that the bigger someone gets, 300K followers on Twitter, he's definitely an activist investor, similar to a few other people. And there's a lot of criticism that comes the bigger you get, right? So he's going to receive a lot of criticism. You get a bear market and people are going to go against them. And then a bull market, people like him, right? And that's because he pronounces his thoughts very loudly on Twitter. And usually, like, when you swing a lot on one side, you're going to get a lot of disagreements from the other side. And then you'll get a lot of people who agree with you on one side, right? So, yeah, I mean, he's been talking about since the bear market. And I think one thing we need to know when it comes to a lot of this is conviction, right? So you want to have conviction in the companies you invest in, because there will be a bear market, guys. There will be. I don't know when, who knows when it's going to be, but there will be a bear market at some point. And when that happens, like we saw last April, you had to have known what you owned, and you'd have to have known what to continue buying, because that was a nasty bear market we had in a matter of a few months. And today we're back near all-time highs. I think maybe like 2 or 3% from all-time highs. And there's a lot of fear going around. And you if you've built your conviction around your own thesis, right, not borrowing conviction, then you shouldn't really be afraid of a pullback. But if your favorite follower on Twitter is Mike Alfred, and you're only buying it because he's bullish, take like a week to research a company and understand why he's bullish a company, right? And understand his thesis instead of just like following someone blindly. Because it'll be pretty scary if you just follow someone blindly and the stock goes down. You're gonna be like looking, hoping like for an answer from them to kind of convince you to keep holding onto the stock. So it's better to, if these people, they're providing their own thoughts on a public platform. All right. That's what we're all doing. It's literally just providing our thoughts on a public platform. It's all entertainment, but it's your job as an investor and a manager of your own money to put whatever you can in things that you're convinced, right? So you have to remember that. Mike is the king of SHIT posting. Well, I mean, he has a very strong personality, so he's going to be very strong in what he has to say, right? So what do I think of him? Well, I try to stay open-minded with people and not try to judge them. And I have to be honest, there's a few people on Twitter that I will just like dismiss. Ooh, hold up. Oh, okay. Not yet. There's a few people on Twitter where like I just like would dismiss them. And then like when I start following them, I'd start to like read and like watch it. Like I've listened to podcasts with Mike Alfred, and he's been a long way. And I would say that it seems like he knows what he's doing because he's doing it pretty well. Like he's been talking about certain stocks since they were down and now they're up a lot. It's like, isn't the point to make money? So like, if you're making money doing what you're doing, then like, why criticize someone for that? Now, the only thing I can say is on Twitter for people who say that like now's the bottom or now's the top. And I think people like that, and I don't know if he does it or not. I just know that he's very bullish his companies as part of the board and whatever. So of course he's going to have his opinion about it. But with other people out there, it's like people like strongly say like this is the top or this is the bottom. And I'm dismissive about comments like that because you don't know where the top is. You certainly don't know where the bottom is. If you did, then you wouldn't have the Citadel pumping billions and billions and hundreds of billions of dollars, not hundreds, maybe tens of billions of dollars into software that's able to predict this. Are you saying that you have figured out the code that you don't need to spend billions of dollars to figure out where the market is going? Because you don't. No one knows where the market's going to go tomorrow. We could be up tomorrow. We could be down tomorrow. But there is no right way to make money. I disagree. I think the right way to make money is subjective. I think the right way to make money is having your own conviction in what you own and continuously buying. So anyways, I think the conference call is going to start soon. So I'm going to take this off of mute. I'm going to put myself on mute. I'm going to leave this playing for a minute while I take a look at some stuff on mine. All right.
Are in on Elon Musk's pay package at Tesla. Phil, what happened?
75% approved it, John. So Elon Musk will remain as CEO of Tesla. He threatened to leave if he didn't get this pay package approved by the shareholders. 75% voted for it. And now Elon Musk is about to talk at the Tesla shareholder meeting. We know what his message is going to be. The future is all about autonomous, robotics, and artificial intelligence. By the way, on the question of whether or not Tesla should invest in XAI, that was an advisory vote. There was more votes for it than against it, but a number of abstentions. So the company says they will continue to study that before making a decision. And there, as you take a look at the shareholder meeting, not a surprise. You knew that you would see the humanoid robots take some kind of a start. Turn here because that is the future for Tesla. And Elon Musk now talking with shareholders at the Gigafactory in Austin. Again, guys, his pay package has been approved by 75% of the Tesla shareholders who voted.
overwhelming margin there. The robots are dancing, which maybe represents how Elon feels inside. Phil, thank you. And now, in the absence of tomorrow's jobs data, we're looking at other data to give us a glimpse into the economy. LinkedIn is out with its monthly jobs report showing a 6% year-over-year drop in hiring in October, down more than 24% from pre-pandemic. For more on the numbers, let's bring in
We're still waiting for the conference call to start.
LinkedIn's head of economics for the Americas, Corey Kentenga. Corey, we
live with a presentation. For those that have dialed in via phone, you can elect to ask a question via the moderator after our prepared remarks. Before we begin, I'd like to remind you that certain statements that we make during the conference call may constitute forward-looking statements, and Iren cautions listeners that forward-looking information and statements are based on certain assumptions and risk factors that could cause actual results to differ materially from the expectations of the company. Listeners should not place undue reliance on forward-looking information or statements, and I'd encourage you to refer to the disclaimer on slide 2 of the accompanying presentation for more information. With that, I'll now turn over the call to Dan Roberts.
Thanks, Mike, and thank you all for joining us for Iren's Q1 2026 earnings call. Today we'll provide an overview of our financial results for the first fiscal quarter ending September 30, 2025, highlighting key operational milestones and importantly discuss how our AI cloud strategy is driving strong growth. We'll then open the call for questions at the end. So Q1 FY26 results. Fiscal year 2026 is off to a really good start. We delivered a 5th consecutive quarterly increase in revenues and a strong bottom line. Revenue reached $240 million and adjusted EBITDA was 92. Noting, of course, that net income and EBITDA, importantly, reflected an unrealized financial gain on financial instruments. This performance reflects our continued, the team's disciplined execution, along with the benefits of having a resilient, vertically integrated platform. Microsoft and the cloud contract. So earlier this week, we announced a $9.7 billion AI cloud contract with Microsoft, which was a defining milestone for our business that underscores the strength and scalability of our vertically integrated AI cloud platform. The agreement not only validates our position as a trusted provider of AI cloud service, but also opens up access to a new customer segment among the global hyperscalers. Under this 5-year contract, Iren will deploy NVIDIA GB300 GPUs across 200 megawatts of data centers at our Childress campus. The agreement includes a 20% upfront prepayment, which helps support capital expenditures as they become due through 2026. The contract's expected to generate approximately $1.94 billion in annual recurring revenue. Beyond the obvious positive financial impact, the contract carries strategic value of significance for us. It not only positions Iren as a contributor towards Microsoft's AI roadmap, but also demonstrates to the market our ability to serve an expanded customer base, which includes a range of model developers, AI enterprises, and now one of the largest technology companies on the planet. As enterprises and other hyperscalers accelerate their AI build-out, we expect that our combination of power, AI cloud experience, and execution capability will continue to position us as a partner of choice. Looking ahead, we're executing now on a plan that will see our GPU fleet scale from 23,000 GPUs today up to 140,000 GPUs by the end of 2026. When fully deployed, this expansion is expected to support in the order of $3.4 billion in annualized run rate revenue. Importantly, this expansion leverages just 16% of our 3 gigawatts in secured power, leaving ample capacity for future expansion. With that overview in mind, let's turn to the next section, a closer look at our AI cloud platform and how we're positioned to scale in the years ahead. So as I alluded to earlier, a key driver of Iren's competitive advantage in AI cloud services is our vertical integration. We develop our own greenfield sites, engineer our own high voltage infrastructure, build and operate our own data centers, and deploy our own GPUs. Simply put, we control the entire stack, from the substation all the way down to the GPU. We believe strongly that this end-to-end integration and control is a key differentiator that positions us for significant growth. This model of vertical integration eliminates dependence on third-party colocation providers and, most importantly, removes all counterparty risk associated. This allows us to commission GPU deployments faster with full control over execution and uptime. For our customers, this translates into scalability, cost efficiency, and a superior customer service with tighter control over performance, reliability, and delivery milestones, driving tangible value and certainty. For those reasons, our customers, including Microsoft, view Iren as a strategic partner in delivering cutting-edge AI compute, recognizing our deep expertise in designing, building, and operating a fully integrated AI cloud platform. On that note, we're excited to announce a further expansion of our AI cloud service, targeting a total of 140,000 GPUs by the end of 2026. This next phase includes the deployment of an additional 40,000 GPUs across our Mackenzie and Canal Flats campuses, which are expected to generate in the order of $1 billion in additional ARR. When combined with the $1.9 billion expected from the Microsoft contract and $500 million from our existing 23,000 GPU deployment, this expansion provides a clear pathway to approximately $3.4 billion in total annualized run rate revenue once fully ramped. Importantly, this incremental 40,000 GPU build-out will be executed in a highly capital efficient manner through leveraging existing data centers. While we have not yet purchased GPUs for the deployment, we continue to see strong demand for air-cooled variants of NVIDIA's Blackwell GPUs, including both the B200 and the B300. And given their efficient deployment profile, we expect these to form the basis of this expansion. That said, we will continue to monitor customer demand closely and pursue growth in a disciplined, measured way. This full expansion to 140,000 GPUs will only require about 460 megawatts of power, representing roughly 16% of our total secured power portfolio. This leaves substantial optionality for future growth and, importantly, continued scalability across our portfolio. The key takeaway here is that we have substantial near-term growth being actively executed upon, but also have significant and additional organic growth ahead of us. Turning now to slide 8, which highlight the British Columbia data centres supporting our expansion to 140,000 GPUs. At Prince George, our ASIC to GPU swap-out program is progressing well. The same process will soon extend to our Mackenzie and Canal Flats campuses, where we expect to migrate ASICs to GPUs with similar efficiency and speed. Together, these sites are allowing us to fast-track our growth in supporting high-performance AI workloads, scaling it into what is becoming one of the largest GPU fleets in North America. Turning to Childress, where we are now accelerating the construction of Horizons 1 to 4 to accommodate the phased delivery of NVIDIA GB300 NVL72 systems for Microsoft. We've significantly enhanced our original design specifications to meet hyperscale requirements and also further ensure durable long-term returns from our data center assets. The facilities are being engineered to Tier 3 equivalent standards for concurrent maintainability, ensuring continuous operations even during maintenance windows. A key feature of this next phase is the establishment of a network core architecture capable of supporting single 100 megawatt superclusters, a unique configuration that enables high-performance AI training for both current and next-generation GPUs. We're also incorporating flexible rack densities ranging from 130 to 200 kilowatts per rack, which allows us to accommodate future chip generations and the evolving power and density requirements without major structural upgrades. While these design enhancements have resulted in incremental cost increases, they provide long-term value protection, enabling our data centers to support multiple generations and reduce recontracting risk typically associated with lower spec builds. In short, we're building Childress not just for today's GPUs and the Microsoft contract in front of us, but also for the next generations of AI compute. Beyond the accelerated development of Horizons 1 through to 4, the remaining 450 megawatts, as you can see in the image on screen, of secured power at Childress provides substantial expansion potential for future Horizons, numbered 5 through to 10. Design work's underway to enable liquid-cooled GPU deployments across the entire site, positioning us to scale seamlessly alongside customer demand. Finally, turning to Sweetwater, our flagship data center hub in West Texas, which has been somewhat overshadowed in recent months by the activity in Childress and Canada. At full build-out, Sweetwater will support up to 2 gigawatts, 2,000 megawatts of gross capacity, all of which has been secured from the grid. As shown in the chart, this single hub rivals and in most cases exceeds the entire scale of total data center markets today. While the recent headlines have naturally been dominated more about our AI cloud expansion at other sites, Sweetwater is a pretty exciting platform asset, giving us the capability to continue servicing the wave of AI compute demand. Sweetwater 1 energization continues to remain on schedule, with more than 100 people mobilised on site to support construction of what is becoming one of the largest high-voltage data centre substations in the United States. All exciting stuff. With that, I'll now hand over to Anthony, who will walk through our Q1 FY26 results in more detail.
Thanks, Dan, and thanks everyone for your attendance today. Continued operational execution was reflected in another quarter of strong financial performance. Q1 FY26 marked our 5th consecutive quarter of record revenues, with total revenue reaching $240 million, up 28% quarter over quarter, and 355% year over year. Operating expenses increased primarily on account of higher depreciation, reflecting ongoing growth in our platform and a higher SG&A. The latter primarily driven by a materially higher share price, resulting in acceleration of share-based payment expense and a higher payroll tax expense associated with employees. $63 million were both significantly up, largely on account of unrealized gains on prepaid forward and cap call transactions entered into in connection with our convertible note financings. Adjusted EBITDA was $92 million, reflecting continued margin strength, partially offset by that higher payroll tax of $33 million accrued in the quarter on account of strong share price performance. Turning now to our recently announced AI cloud partnership with Microsoft. As Dan mentioned, this is a very significant milestone for Iren. It not only delivers strong financial returns, but also creates a significant long-term strategic partnership for the business. Focusing on the financials, the $9.7 billion contract is expected to deliver approximately $1.9 billion in annual revenue once the 4 phases come online, with an estimated 85% project EBITDA margin. This strong margin, which reflects our vertically integrated model, incorporates all direct operating expenses across both our cloud and data center operations, supporting the transaction, including power, salary and wages, maintenance, insurance, and other direct costs. These cash flows deliver an attractive return on the cloud investment, i.e. the 5.8 billion capex for the GPUs and ancillaries, after deducting an appropriate internal co-location charge, ensuring that the project delivers robust cloud returns, as well as an attractive return on our long-term investment in the Horizon data centers, which will deliver returns for many years into the future. The transaction has also a number of features that allow us to undertake the transaction in a capital efficient way. Firstly, the payments for the capex are aligned with the phased delivery of the GPUs across the calendar year 26, as we deliver those 4 phases. Secondly, the 1.9 billion in customer prepayments, being 20% of total contract revenue, paid in advance of each tranche, provides funding for circa 1/3 of the funding requirement at the outset. Thirdly, the combination of the latest generation of GPUs and the very strong credit profile of Microsoft should allow us to raise significant additional funding secured against the GPUs and the contracted cash flows on attractive terms. While the final outcome will be subject to a range of considerations and factors, we are targeting circa 2.5 billion through such an initiative, and depending on final terms and pricing, there is meaningful upside to that, noting again the very high quality of our counterparty. We also have a range of options available to fund the remaining 1.4 billion, including existing cash balances, operating cash flows, and a mix of equity, convertible notes, and corporate instruments. On that note, turning more generally to capex and funding. We continue to focus on deepening our access to capital markets and diversifying our sources of funding. We issued 1 billion in zero coupon convertible notes during October, which was extremely well supported. And we also secured an additional 200 million in GPU financing to support our AI cloud expansion in Prince George, bringing total GPU-related financings to 400 million to date at attractive rates. Taking into account recent fundraising initiatives, our cash at the end of October stood at 1.8 billion. Our upcoming capex program, which includes the construction of the Horizon data centers for the Microsoft transaction, will be met from a combination of this strong starting cash position, operating cash flows, the Microsoft prepayments as just noted, and other financing streams that are underway. These include the GPU financing facilities that we discussed, as well as a range of other options under consideration, from other forms of secured lending against our fleet of GPUs and data centers through to corporate level issuance, whilst maintaining an appropriate balance between debt and equity to maintain a strong balance sheet. With that, we'll now turn the call over to Q&A.
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press * then 2. If you're using a speakerphone, please pick up the handset to ask your question. The first question today comes from Nick Giles from B. Riley Securities. Please go ahead.
Yeah, thank you, operator. And hi, everyone. Thanks so much for the update today. Guys, I want to congratulate you on this significant milestone with Microsoft. This was really great to see. I have a two-part question. Dan, you mentioned strategic value, and I was first hoping you could expand on what this deal does from a commercial perspective. And then secondly, I was hoping you could speak to the overall return profile of this deal and how you think about hurdle rates for future deals. Thank you very much.
Sure. Thanks, Nick. Appreciate the ongoing support. So in terms of the strategic value, I think undoubtedly proving that we can service one of the largest technology companies on the planet has a little bit of strategic value. But below that, the fact that this is our own proprietary data center design, and we've designed everything from the substation down to the nature of the GPU deployment, and that has been deemed acceptable by a trillion-dollar company. I think that's got a bit of strategic value, both in terms of demonstrating to capital markets and investors that we are on the right track, but also importantly in terms of the broader customer ecosystem and that validation. And look, we've seen that play out over the days since the announcement. In terms of hurdle rates and returns, I think it's worth Anthony if he can to jump into this. I think it's fair to say that IRRs, hurdle rates, and financial models have dominated our lives for the last 6 weeks. So there's probably a little bit we can outline in this regard.
Sure. Thanks, Dan, and thanks for the question. Just in terms of the returns on the transaction, obviously, as I noted in the introductory comments, when we look at the cloud returns, we obviously take away what we think to be an arm's length co-location rate, so effectively charge the deal for the cost of renting the data center capacity. After we take that in account on an unlevered basis, and assuming that there are zero cash flows or RV associated with the GPUs after the term of the contract, we expect an unlevered IRR of low double digits. Obviously, we'll be looking to add some leverage to the capital structure for the transaction, as we also discussed. And once we take that target 2.5 billion of additional leverage into account, you're achieving a levered IRR in the order of circa 25 to 30%. Obviously, that is assuming that $2.5 billion package. And it also assumes that the remaining funding is coming from equity as opposed to other sources of capital, which we might also have access to. I'd also note that we said that might well be upside on that 2.5 billion. Obviously, at a $3 billion leverage package against the GPUs on a secured financing package, you could see that levered return increase by circa 10%. In terms of the RV, we've obviously in those numbers, we're just reflecting zero economic value in the GPUs at the end of the term. If, for example, you were to assume a 20% RV, obviously that has a material impact. Unlevered IRRs would increase to high teens, and your levered IRRs would be somewhere between 35 to 50%, depending on your leverage assumptions.
Yeah, I think maybe just to jump in as well. Thanks, Anthony. That's all absolutely correct. And there are a lot of numbers in there, which is demonstrative of the amount of time we've spent thinking about IRRs. So I think just to reiterate a couple of points. One is we've clearly divided out our business segments into standalone operations for the purposes of assessing risk return against a prospective transaction. So to be really clear, all of those AI cloud IRRs assume a co-location charge. So they assume a revenue line for our data centers. So our data centers, we've assumed to earn internally $130 per kilowatt per month escalating, which is absolutely a market rate of return, particularly considering the first 5 years is underwritten by a hyperscale credit. So that's probably the first point I'd make. But it's also really important to mention that we've optimized elsewhere. So the 76,000 GPUs that we've procured for this contract at a $5.8 billion price, Dell have really looked after us to the point where they've got an inbuilt financing mechanism in that contract where we don't have to pay for any GPUs until 30 days after they're shipped. So there's further enhancements there. And then the final point I'd reiterate is this 20% prepayment, which I don't believe we've seen elsewhere, accounts for a third of the entire CapEx of the GPU fleet. And I guess we've been asked previously why we would prefer to do AI cloud versus co-location. As one very single small data point, we are getting paid a third of the CapEx upfront here as compared to having to give away equity, big chunks of equity in our company to get access to a co-location deal. So we're really pleased and to lead us towards that $3.4 billion in ARR by the end of 2026 on returns that are pretty attractive. Yeah, it's a good result.
Anthony, Dan, I really appreciate all the detail there. One more, if I could. I was just wondering if you could give us a sense for the number of GPUs that will ultimately be deployed as part of the Microsoft deal. And then as we look out to year 6 and beyond, I mean, can you just speak to any of the kind of future proofing you've done of the Horizon platform and what can ultimately be accommodated in the long term for future generations of chips?
Yep, I'm happy to jump in and take that one down. So in terms of the number of GPUs to service this contract, draw your attention to some of our previous releases where we've said that each phase of Horizon would accommodate 19,000 GB300s. And obviously we're talking about 4 phases here with respect to that. In terms of future-proofing of the data centers, there are a number of elements to it, but the primary one is that we have designed for rack densities here that are capable of handling well in excess of the GB300 rack architecture. And to give you specific numbers there, the GB300s are around 135 kilowatts a rack for the GPU racks, and our design at the Horizon facilities, it can accommodate up to 200 kilowatts a rack. So that is the primary area where we have future-proofed the design. But as Dan also mentioned in the remarks on the presentation, we have enhanced the design in a number of ways, including effectively what is full Tier 3 equivalent concurrent maintainability. So yeah, there are a number of elements that have been accommodated into the data centers to ensure that they can continue to support multiple generations of GPUs.
Very helpful, Ken. Guys, congratulations again and keep up the good work.
Thank you. The next question comes from Paul Golding from Macquarie. Please go ahead.
Thanks so much for taking the question, and congrats on the deal and all the progress with HPC. I wanted to ask, I guess this is a quick follow-on to the IRR question. Just on our back of the envelope math, it looks like pricing per GPU hour may be on the rise or at the higher end of that $2 to $3 range, assuming full utilization, so presumably potentially even higher. How should we think about the pricing dynamics in the marketplace right now on cloud, given the success of this deal and what seems to be fairly robust pricing? And then I have a follow-up. Thank you.
Sure.
Hi, Paul.
Oh, sorry.
You go ahead, Dan.
Sorry, Ken. Look, I'll let Kent talk a bit more about the market dynamic, but it is absolutely fair to say that we're seeing a lot of demand. That demand appears to increase month on month in terms of the specific dollars per GPU hour. We haven't specified that exactly. However, we have tried to give a level of detail in our disclosures, which allows people to work through that. I think importantly for us, rather than focusing on dollars per GPU hour, which I think your statement is correct, is focus on the fundamental risk return proposition of any investment. And when we've got the ability to invest in an AI cloud, delivering what is likely to be in excess of 35% levered IRRs against a Microsoft credit, I mean, you kind of do that every day of the week.
Yeah, thanks, Dan. And Paul, with regard to your specific question around demand, we continue to see very good levels of demand across all the different offerings we have. The air-cooled servers that we are installing up in our facilities in Canada lend themselves very well to customers who are looking for 500 to 4,000 GPU clusters and want the ability to scale rapidly. As we've discussed before, transitioning those existing data centers over from their current use case to AI workloads is a relatively quick process, and that allows us to service the growth requirements of customers in that class very well. And case in point, we've been able to pre-contract for a number of the GPUs that we purchased for the Canadian facilities well in advance of them arriving out at the sites. And this is something that customers have historically been pretty reticent to do, but that level of demand exists in the market, as well as ongoing trust and credibility of our platform. With both existing and new customers, that is allowing us to take advantage and pre-contract a lot of that away. And then obviously with respect to the Horizon 1 build out for Microsoft, this is the top tier liquid cooled capacity from NVIDIA. We continue to see extremely strong demand for that type of capacity. And the fact that we are able to offer that means that we can genuinely serve all customer classes, from hyperscalers, the largest foundational AI labs and largest enterprises with that liquid cooled offering, down to top tier AI startups and smaller scale inference enterprise users at the BC facilities.
Thanks for that color, Kent and Dan. And as a follow-up, as we look out to Sweetwater 1 energization coming up fairly soon here in April, are you able to speak to any inbound interest you're getting on cloud at that site? I know it's early days just from a construction perspective, maybe for the facilities themselves, but any color there, and maybe whether you would consider hosting at that site, given the return profile and potential cash flow profile that you would get from engaging in the cloud business over a period of time. Thank you.
Yeah, in terms of the level of interest and discussions that we're having, we're seeing a strong degree of interest across all of the sites, including Sweetwater as well. Obviously, very significant capacity available at Sweetwater, as Dan mentioned, with initial energization there in April 2026, which is extremely attractive in terms of the scale and time to power. So I think it's very fair to say that we're seeing strong levels of interest across all the potential service offerings. As it relates to GPU as a service and co-location, as previously, we will continue to do what we think is best in terms of risk-adjusted returns. Anthony outlined the risk-adjusted returns that we're seeing in co-locations, in GPU as a service specifically at the moment. And as we've outlined over the past number of months, that does look more attractive to us today. But as we continue to see increasing supply-demand imbalance within the industry, that may well feed through into co-location returns where it makes sense to do that in the future. But as it stands today, certainly the return profile that we're seeing in GPU as a service, we think is incredibly attractive.
Great. Thanks so much, and congrats again.
Thank you. The next question comes from Brett Knoblauch from Cantor Fitzgerald. Please go ahead.
Hi, guys. Thanks for taking my question. On the $5.8 billion order from Dell, can you maybe parse out how much of that is allocated to GPUs and the auxiliary equipment? And on the auxiliary equipment, say you wanted to retrofit the Horizon data centers with new GPUs in the future, do you also need to retrofit the auxiliary equipment?
So out of that total order amount, I mean, it's fair to say the GPUs constitute the vast majority of it, but there is some substantial amounts in there for the back-end networking for the GPU clusters, which is the top tier InfiniBand offering that's currently available. In terms of future-proofing, we'll have to see how much of that equipment may or may not be reusable for future generations of GPUs. As I was referring to earlier, the vast majority of our data center equipment and the way that we have structured the rack densities within the data center mean that the data center itself is future-proofed. But in terms of the specific equipment for this cluster, it remains to be seen whether that will be able to be reused.
Perfect, thank you. And then on maybe the new 40,000 order that sounds like it's going to be plugged in Canada. You talked about maybe a very efficient CapEx build for those data centers. Could you maybe elaborate a bit more on that? I know when the AI craze maybe first got started, 18 months ago, you guys flagged that you guys are running GPUs up in Prince George that you built for less than $1 million a megawatt. Are we closer to that number for this, or are we just well below maybe what the Horizon 1 4 are costing per megawatt basis?
Yeah, so in terms of the basic transition of those data centers over to AI workloads, it is relatively minimal in terms of the capex that is required. The vast majority of the work is removing ASICs, removing the racks that the ASICs sit on, and replacing those with standard data center racks and PDUs, so the power distribution units that can accommodate the AI servers. So that is relatively minimal. As we've discussed before, it's a matter of weeks to do that conversion. And from a CapEx perspective, it is not material. The one element that may be more material in terms of that conversion is adding redundancy, if required, to the data centers. That would typically cost around $2 million a megawatt. If we need to do that, but obviously in the context of, a full build out like we're seeing of liquid cooled capacity at Horizon, it's extremely capital and CapEx efficient.
Awesome. Thank you, guys. I'll hop back in the queue. Congrats again.
Thank you. The next question comes from Dylan Heslin from Roth Capital Partners. Please go ahead.
Hey, thanks for taking my questions, and passing our congrats on the Microsoft deal as well. To start with Microsoft, was co-location ever on the table with them? Did they come to you asking for AI Cloud, or how did those negotiations sort of fall out?
Just thinking about the best way to answer this. So we've been talking to Microsoft for a long period of time, and the nature of those conversations absolutely did evolve over time. Is their preference the cloud deal? Possibly. But at the end of the day, we want to focus on cloud, and that was the transaction we were comfortable with. So conversations really focused around that over the last 6 weeks or so. I think if I may, I'd talk more generically around these hyperscale customers, because obviously we weren't just talking to Microsoft. I think there probably is a stronger preference from those to be looking at more co-location and infrastructure deals rather than cloud deals, but also is the case that there's an appetite for a combination. So it may be that we do some co-location in the future. But yeah, I think different hyperscalers have different preferences. We'll entertain them all, but given the nature of the deal we did with a 20% prepayment funding a third of CapEx and a 35% plus equity IRR, we're feeling pretty good about pursuing AI Cloud.
Got it. Thank you. And just as a follow-up with the rest of Childress, is there any significance to the size of the Microsoft deal starting at 200 megawatts? Do they have interest in the rest of the campus? Have you talked to them about that yet?
So again, I'm going to divert the question a little bit because we've got some pretty strong confidentiality provisions. So let me talk generically. There is appetite from a number of parties in discussing cloud and other structures well above the 200 megawatts that's been signed with Microsoft.
Okay, great. Thanks.
Thank you. The next question comes from John Todaro from Needham. Please go ahead.
Great. Thanks for taking my question, and congrats on the contract. I guess just one on that, as we dig a little bit more in, any kind of penalties or anything related to the timeline of delivering capacity? Just wondering if there's guardrails around that. And then I do have a follow-up on CapEx.
There's always a penalty, whatever you do in life, if you don't do what you promise you're going to do. So we're very comfortable with the contractual tolerances that have been negotiated, the expected dates versus contractual penalties and other consequences. I can't comment more specifically beyond that on this call. But the other thing I would reiterate is we have never, ever missed a construction or commissioning date in our life as a listed company. So I think you can take a lot of comfort that if we've put something forward to Microsoft and agreed it there, and if we've put something forward to the market, our reputations are on the line, our track record is on the line. We're going to be very confident we can deliver it and potentially even exceed it.
Got it. Understood. And then just following up on the CapEx, that 14 to 16 million on the, I think it was the data center side. Just wondering if there's anything kind of additional in there that would get it north of the colo items other folks are talking about, if maybe there's some networking or cabling included in that, or any contribution from tariffs are being considered there?
Yeah, happy to give some additional color there. So yes, in terms of networking, etc. Again, as Dan mentioned in his presentation earlier, this is designed. The Horizon campus is designed to be able to operate 100 megawatt superclusters. Now that does raise a significant level of additional infrastructure that is required over being able to deliver smaller clusters. And so certainly some of the costs that are in the number that you mentioned are related to the ability to do that. And that will not necessarily be a requirement of every customer moving forward. So that probably is an element that is somewhat unique.
Understood. Thank you, guys.
Thank you. The next question comes from Stephen Glagola from Jones Trading. Please go ahead.
Hey, thanks for the question. On your British Columbia GPUs, can you maybe just provide an update on where you guys stand with contracting out the remaining 12,000, I believe, GPUs of the initial 23,000 batch? And are you seeing any demand for your bare metal offering in BC outside of AI native enterprises? Thank you.
Yeah, happy to give an update there. We'd previously put out guidance a couple of weeks ago that we'd contracted 11,000 out of the 23,000 that were on order. Subsequent to that, we have contracted a bit over another 1,000 GPUs. And primarily the ones that are not yet contracted are the ones that are arriving latest in terms of delivery timelines. As I mentioned earlier, we are seeing an increased appetite from customers to pre-contract, but these are GPUs that are a little further out in terms of delivery schedules relative to the ones that have already been contracted. Having said that, we continue to see very strong levels of demand, and we're in late stage discussions around a significant portion of the capacity that has not yet been contracted, and continue to see very good demand leading into the start of next year as well, and are receiving an increasingly large number of inbounds from a range of different customer classes. So you mentioned AI natives. Yes, that has been a portion of the customer base that we've serviced previously, but we are also servicing a number of enterprise customers on an inference basis. So it is a pretty wide-ranging customer class that we're servicing out of those British Columbia sites.
Thanks, Ken. Appreciate it.
Thank you. The next question comes from Joe Vafi from Canaccord Genuity. Please go ahead. Joe, your line is open if you'd like to ask your question. I'll move on to the next question in a minute. Oh, sorry.
Yeah, sorry, guys. Really sorry. Congrats from me too on Microsoft. Just maybe, Dan, if you could kind of walk us through what you were thinking in your head. Clearly, some awesome IRRs here on the Microsoft deal, but how are you thinking about risk on a cloud deal here versus a straight colo deal, which, probably wouldn't have had the return, but, maybe the risk profile may be lower there. And then I'll just a quick follow-up. Thanks.
Thanks, Joe. Look, it's funny. I actually see risk very differently. So, we've spoken about co-location deals with these hyperscalers, and if you model out a 7 to 8% starting yield on cost and run that through your financial model, what you'll generally see is that you'll struggle to get your equity back during the contracted term, and then you're relying on recontracting beyond that end of that 15-year period to get any sort of equity return. So in terms of risk, I would argue that there's a far better risk proposition implicit in the deal that we've signed, and going down the cloud route. And then for the shorter term contracts on the colo side, where you may not have a hyperscale credit, you're running significant GPU refresh risk against companies that don't necessarily have the balance sheet today to support confidence in that GPU refresh. So again, we think about it in business segments. We think about our data center business has got a great contract internally linked to Microsoft as a tenant. And that data center itself is future-proofed, accommodating up to 200 megawatt rack densities. And it's also the case that in 5 years, the optionality provides further downside protection. So upon expiry of the Microsoft contract, maybe we can run these GPUs for additional years, which we've seen with prior generations of GPUs like the A100s. But assuming that isn't the case, we've got a lot of optionality within that business. We could sign a co-location deal at that point. We could relaunch a new cloud offering using latest generation GPUs. So my concern with these co-location deals is what you're doing is you're transferring an interest or an exposure to an asset that is inherently linked to this exponential world of technology and demand and the upside that may entail. And you're swapping that for a bond position in varying degrees of credit with the counterparties. So if you're swapping an asset for a bond exposure to $1 trillion hyperscaler and you're kind of hoping you might get your equity back after the contracted period, I mean, that's one way to look at it. If you're swapping your equity exposure for a bond exposure in a smaller neo cloud without a balance sheet, then is that a good decision for shareholders? We just haven't been comfortable.
I get it, Dan. And we've run some DCFs here and on some colo deals here in the last couple months, and there's a lot to be learned when you do it. There's no doubt. And then just on this prepayment from Microsoft, I know you've got some strong NDAs here, but kind of a feather in your cap on getting that much in a prepayment. Any other anything else to say on how maybe your qualifications or how Microsoft perhaps and you came to the agreement to pre-fund the GPU purchases out of the box. Thank you.
Look, getting a third of your capex funded through a prepayment from the customer is fantastic from our perspective, and we're super appreciative for Microsoft coming to the table on that. And what that allows us to do is to drive a really good IRR and return to equity for our shareholders. And again, linking back to what Anthony said earlier, we expect 35% equity IRRs from this transaction, accounting after an internal data center charge. So trying to create that apples and apples comparison for a neo cloud that has an infrastructure charge. Even after that, we're looking at 35% plus. And also what's really important to clarify is the equity portion of that IRR we have assumed is funded with 100% ordinary equity, which, given our track record in raising convertibles, given the lack of any debt at a corporate level, is probably conservative again. So from a risk-adjusted perspective, linked to a $1 trillion credit and the ability to fund it efficiently, I mean, we're really happy with the transaction, and hopefully there's more to come.
Great, thanks, Dan.
Thank you. The next question comes from Michael Donovan from Compass Point. Please go ahead.
Thanks for taking my question and congrats on the progress. I was hoping you could talk more to your cloud software stack and the stickiness of your customers.
Yeah, I'm happy to take that one. To date, the vast majority of our customers have required a bare metal offering, and that is their preference. These are all highly advanced AI or software companies like a Microsoft. They have significant experience in the space, and they want the raw compute and the performance benefits that brings, having access to a bare metal offering, and then being able to layer their own orchestration platform over the top of that. So that has been, by design, that we have been offering a bare metal service. It lends itself exactly to what our customers are looking for. Having said all of that, we obviously are continuing to monitor the space, continuing to look at what customers want, and we're certainly able to go up the stack and layer in additional software if it is required by customers over time. But today, as I said, we haven't really seen any material levels of demand for anything other than the bare metal service that we're currently offering.
And I think maybe just to add to that, Kent, if you step back and think about it, you're contracting with some of the largest, most sophisticated technology companies on the planet that want access to our GPUs to run their software. It's kind of upside down world to then turn around and say, oh, we'll do all the software and operating layer. Like, clearly they're in the position they are because they have a competitive advantage in that space. They're just looking for the bare metal. I think as the market continues to develop over coming years, it may be the case that if you want to service smaller customers that don't have that internal capability or budget, then yes, maybe you will open up smaller segments of the market. But for a business like ours that is pursuing scale and monetizing a platform that we've spent the last 7 years building, it's very hard to see how you get scale by focusing on software, which is, I think everyone generally accepts, is going to be commoditized anyway in coming years, as compared to just selling through the bare metal and letting these guys do their thing on it.
That makes sense. I appreciate that. Now, you mentioned design works are complete for a direct fiber loop between Sweetwater 1 and 2. How should we think about those two sites communicate with each other once they're live?
Yeah, I think really the best way to think about is it just adds an additional layer of optionality as to the customers that would be interested in that and how we contract those projects. There are a number of customers out there who are looking particularly for scale in terms of their deployments. And obviously being able to offer 2 gigawatts that can operate as an individual campus, even though the physical sites are separated, is something that we think has value, and that's why we've pursued that direct fiber connection.
Appreciate that. Thank you, guys.
Thank you. At this time, we're showing no further questions. I'll hand the conference back to Dan Roberts for any closing remarks.
Great. Thanks, operator. Thanks, everyone, for dialing in. Obviously, it's been an exciting couple of months, and particularly last week. Our focus now turns to execution to deliver 140,000 GPUs through the end of 2026, but also continuing the ongoing dialogue with a number of different customers around monetizing the substantial power and land capacity we've got available and our ability to execute and deliver compute from that. So appreciate everyone's support. Look forward to the next quarter.
Okay, so that was a mediocre earnings call. I think there are more than a few things that management could not answer that they were trying to look for answers for. But I will provide my commentary for that on a separate video. I do need to look at the transcript and kind of see the answers there, but they did not have answers to certain questions, or at least the answers that the analysts were looking for. Anyways, guys, I'm going to wrap this one up. Again, I need to look more into the transcript, look at the answers they're providing, but it didn't sound like there was any additional news that that we didn't already know coming to this earnings, other than, of course, the finances and the, what is it, like $3.8 billion ARR. So, we're going to continue to look at the numbers of that one, but I mean, the earnings call was okay. It could have been better. I think there was a bit of hype heading to the earnings based on some responses they give. The thing is that this whole industry is evolving very quickly, and I think the analysts are looking for clarity around the deal on itself, but they can't give that information based on the what's it called, based on the confidence of the deal on its own. Like, so I don't really know how to explain it, but like, it's clear like they can't say certain things. But you guys here are like saying that they need better speakers. I didn't really like how confident they were on the answers. It seemed like either that they were trying to avoid answering the question completely, or maybe they could not provide the answers, because it did seem like the analysts were asking the same questions over and over again, just in different ways. But at the end of the day, we're going to continue to see some criticism on this Microsoft deal. I could already see it. From what I've heard so far on the earnings call, it wasn't like oh, okay, that makes sense sort of thing. I think it just takes a little bit of confidence in the management, right? So if you believe in management, then that is the reason to own the stock. And if you don't, then it's probably a good idea to not own the stock specifically. Am I going to continue holding? I'm going to continue my holding position. I sized it right just in case there's going to be additional volatility. The stock is down about 12% during the market hours. It's about flat after hours. It was up as much as 8%, but it was also down as much as 5%. So we'll see how it goes. I think a lot of this is really going to be attributed to the macro of the market, right? So if the market's down tomorrow, it's likely this is going to be down much more because it's a higher beta stock. So we'll see, guys. We'll see. So hope you guys enjoyed that one. I'm going to, again, go over the transcript, put together some things on my end, and then provide my my opinion later on. But closing this, the earnings didn't really release any new information that we didn't already know, other than the additional ARR or the figure that they did provide. The earnings call on its own, they didn't sound too confident, in my opinion. But I think a lot of that was attributed to the fact that they couldn't say anything based on the non-disclosure agreement of it. So we'll see, guys. For now, talk to you later. I wouldn't really attribute too much of the price action, because we've seen it like, what was up like 4% after hours yesterday. I think it was like around $80. And then now today we're at 67. So, kind of take your time a little bit to solidify your thesis on it, as I will do mine. But I did adjust the size of my position based on that risk that's in its own. Okay. So just want to sound that out to you guys, because at the end of the day, I mean, we're on like 3% for the all-time highs. So if we have a 5% pullback, then you can imagine a stock like this would go down further. That's just the risk you'd be willing to take going into it. So can you also talk about Nebius since the earnings call coming? I mean, they report next week, so there really isn't much to say on that one. As far as the previous earnings call, I think those guys, they're a bit more experienced in this field because they've been doing it for decades. When it comes to Iren, they've been doing it for over 10 years. But these are more finance guys than anything. As far as the CEO, Dan Roberts, he has a strong finance background. So when they ask questions about like the technical stuff, they shifted it over to the chief commercial officer, Ken Draper, who was able to answer those questions. When it comes to Nebius, those guys are all like tech focused. So they're very good with those questions. Of course, they have the chief business officer, Roman, who will be able to assist with that. So I'd imagine on the Nebius conference call, you're going to have Arkady Velaz and also Roman on there, and maybe a couple of other people, including the CFO. So yeah, guys, again, my thoughts, the earnings call is okay, and I think the stock price reflects that. It's not up 8%, it's up 1%.